When it comes to insurance, you pay for it in a few different ways. You've got your premium, your deductible, and if things go wrong, you hopefully get a payout. But only one of those is a guaranteed cost you will never, ever get back. So, which one is it? We're about to break down what you're really paying for and reveal the one fee that is always a cost, no matter what. Subscribe and continue the problem. Let's be real, insurance can feel like learning a new language. You're hit with terms like premiums, deductibles, copays, and out-of-pocket maximums. It's an alphabet soup of financial jargon that can make your head spin. You know you're paying for it, sometimes a lot, but what does it all mean? It all just feels like a cost. Every time that auto payment goes through, you might wonder, am I just throwing this money away? It can feel like you're paying for something you might never use, especially if you're a safe driver or in perfect health. This leads to the big question, of all the money changing hands, which part are you absolutely, positively guaranteed to pay and never see again? They all feel like money leaving your wallet, but here's the secret, they don't all work the same way. Most insurance costs are conditional, they only happen if something else happens first. But one of them isn't. One of them is the non-negotiable price of admission, and figuring out which one it is will completely change how you look at your policy. Deconstructing the conditional costs before we get to the one unavoidable cost, let's eliminate the things it isn't. First up, the easy one, the payout. A payout is the money the insurance company pays to you, or on your behalf, when you file a claim. If a storm damages your roof and the repairs cost $20,000, the check they send to the contractor is the payout. This isn't a cost to you, it's the whole reason you have insurance. It's the financial safety net you've been paying for. So, the payout is the benefit, not the cost. We can cross that off the list. Next, let's talk about a far more confusing term, the deductible. The deductible is what you have to pay out of pocket for a loss before your insurance company starts paying. Think of it as your skin in the game. It's how insurance companies share the risk with you. Let's say your car insurance has a $500 deductible. You get into a fender bender, and the repair bill is $3,000. You are on the hook for the first $500. Once you've paid that, your insurer steps in and covers the remaining $2,500. If the bill was only $400, you'd just pay it yourself and wouldn't file a claim, because the damage is less than your deductible. And here's the key insight, a deductible is a conditional cost. You only pay it if you have a claim. You could drive for 10 years without an accident and you will never pay a single dime of your deductible. If your house never has a fire or a flood, the deductible is just a number on a piece of paper. It's a potential cost, not a sunk cost. It only wakes up when something bad happens. This is why choosing your deductible is a strategy. A higher deductible means you're taking on more risk, and in return, the insurance company gives you a lower monthly bill. A lower deductible means you're paying for more peace of mind with a higher monthly bill. Either way, it's a cost you might pay, not one you always pay. The reveal, the unavoidable costs. So, if the payout is money you get back and the deductible is a cost you only pay if you make a claim, what's left? What is the one cost that's always there, no matter how safely you drive or how healthy you are? The one, unavoidable, guaranteed cost of insurance is the premium. Your insurance premium is the fixed amount you pay on a regular schedule, usually monthly or yearly, to keep your policy active. It's a subscription fee. Think of it like Netflix. You pay that fee every month whether you watch one movie or 100. That payment just grants you access to the service. Your premium works the exact same way. You pay it to keep your coverage, regardless of whether you ever file a claim. If you stop paying your premium, your policy gets cancelled. Simple as that. It is the price of admission to the whole system. This is what's known as a sunk cost, money that's been spent and can't be recovered. Whether you have a perfect, claim-free year or a year from hell, that premium money is gone. You don't get a refund for good behavior. So why does it work this way? It all comes down to the core idea of insurance: pooling risk. Insurance companies collect premiums from millions of people and put it all into one giant pool of money. Most of those people won't have a major claim in a given year. But a few of them will face something catastrophic: a huge medical bill, a bad car crash, a house fire. The cost of these events can be astronomical. The insurance company uses that giant pool of everyone's premiums to pay for the massive losses of the few. Your premium isn't just buying your own protection, it's your contribution to a collective safety net. It's what ensures the money is there for anyone in the pool who has a bad day. Why this changes everything? Okay, the premium is the one guaranteed cost. So what? Why does knowing this actually help you? Because it empowers you to make smarter financial decisions. First, you can now treat your premium like any other fixed bill in your budget, like rent or a car payment. It's not a maybe cost, it's a definite one. This makes financial planning clean and predictable. You know exactly what you need to set aside to stay protected. Second, and more importantly, it helps you master the central trade-off in all of insurance: the seesaw relationship between the premium and the deductible. These two costs are almost always inversely related. A low premium, your guaranteed monthly cost, usually comes with a high deductible, your potential if cost. A high premium usually comes with a low deductible. When one goes up, the other goes down. By understanding that the premium is your guaranteed cost and the deductible is your conditional risk, you can pick a plan that actually fits your finances and your risk tolerance. For example, meet ready for anything Rebecca. She's risk-averse and the thought of a surprise $4,000 bill makes her anxious. She'd rather have predictable costs. So, she chooses an insurance plan with a higher monthly premium. It costs her more each month, but her deductible is only $500. She's paying more in guaranteed costs to lower her potential conditional cost. Then there's Savvy Saver Sam. He's young, healthy, and has a solid $5,000 emergency fund. He's comfortable taking on more risk to save on his fixed expenses. He opts for a high deductible plan. His monthly premium is way lower, freeing up his cash flow. He knows that if something major happens, he'll have to pay that $4,000 deductible, but it's a risk he's willing and able to take. He is minimizing his guaranteed cost by accepting a higher conditional one. Neither choice is right or wrong. The best choice is personal. The power comes from understanding the game. You are balancing a guaranteed cost against a potential one. By focusing on the premium as the true, unavoidable cost, you can anchor your decision and build a strategy that works for you. Conclusion: so let's wrap it up. An insurance policy has a lot of numbers that look like costs. But the payout is the benefit you get. The deductible is a conditional cost you only pay if you file a claim. But the premium? That is the one cost you always pay. It's the steady, non-refundable fee for access to a system of protection. It is the ticket that keeps your safety net in place. Understanding this simple distinction turns you from a confused passenger into an informed driver of your financial life. You can now weigh the guaranteed cost of the premium against the potential risk of the deductible and choose a plan that truly fits your budget and gives you real peace of mind. If this cleared things up and made insurance feel a little less confusing, do us a solid and hit that like button. And for more simple guides to complex financial topics, make sure you're subscribed. Now let us know in the comments, what other insurance questions do you want us to tackle next?